Hi, and thank you for joining this month's Market Minute. My name is Mike Mills, and I'm the co-founder and managing partner of the Legacy Advisor Group. Today is Tuesday, September 30th, 2025. Each month, I like to give an update on the market, something we're keeping an eye on, and a relevant piece of news. But let me first start with that it goes without saying that the month of September and events of 2025 will be forever remembered. It breaks our hearts to see the division and violence in our country, and we pray for unity in this great country. For September, the S&P 500, NASDAQ, and MSCI EAFE are up so far, albeit not as high as some recent months. We've also seen all three showing signs of taking a breather these last few weeks. As the markets are a bit frothy, this comes as no surprise, and we maintain our stance that we could see a pullback before year-end. The Federal Reserve cut rates by 25 basis points in September. Not a surprise to many. With the Fed funds rate now at 4 to 4.25, the market had seemingly priced this in before the cut. The dot plot shows a median expectation of additional rate cuts this year, and the consensus is that we'll see further easing through the end of 2026. Oil, with only a slight jump in early June, has remained range-bound in the low 60s most of the summer. OPEC is currently considering an increase in supply, which could put downward pressure on oil prices. As we record this video, the ongoing saga of a government shutdown weighs in the air. These frequent showdowns always remind me of a quote attributed to Winston Churchill, and that quote is, "American politicians always do the right thing after trying everything else." I'm sure this too shall pass, but nonetheless, it makes for no shortage of content for the talking heads. As a point of reference, we've had 21 government shutdowns since 1976, and so far no recessions have been associated with the shutdown. Let's move on to mortgage rates. I recently talked about mortgage rates on a video, and as we continue to track these, rates have come down slightly. However, not directly from Fed rate cuts. You may recall in the fall of 2024, the Fed cut rates, and then mortgage rates went up. The reason is that determining mortgage rates are not as simple as the Fed lowering rates. Mortgage rates are calculated based on a mix of economic conditions, lender strategies, and borrower-specific factors. Broadly, they are influenced by the Federal Reserve's monetary policy, inflation levels, and the performance of the bond market, especially the 10-year Treasury yields. Lenders also factor in their own costs, desired profit margins, and market competition. For individual borrowers, credit score, loan amount, down payment size, debt-to-income ratio, and the type of loan all play a role in determining the final rate offered. Ultimately, mortgage rates reflect both the cost of borrowing money and the risk associated with lending it. Last but not least this month, we continue to receive questions about AI or artificial intelligence. There are no shortage of opinions on AI, some fearful and others hopeful. So far, and I do believe we are just scratching the surface, AI is helping with business efficiency and productivity. Artificial intelligence is no longer just a buzzword. It's a global economic powerhouse, reshaping industries, governments, and everyday life. In 2025, global AI spending soared to new heights. So far, the United States has led the way, investing over $470 billion. China followed with $119 billion and the UK with $28 billion. Other major players include Canada, Israel, Germany, India, and France, each contributing billions to the AI race. Tech giants are fueling this revolution. Amazon's investing more than $100 billion in AI and cloud infrastructure. Microsoft, Google, Meta, and NVIDIA are each committing tens of billions to AI models, chips, and data centers. Just recently, we saw where NVIDIA, Oracle, and others have committed hundreds of billions in investment into OpenAI. To be clear, OpenAI is still unprofitable. We'll put a few charts up while I'm talking from our friends at JP Morgan, just so you can see what I mean regarding the spending on AI and then electricity generation. The first shows tech companies in the current and projected spending on AI. The future of AI shows even more ambitious spending projected. By 2026, global AI spending is projected to hit $2 trillion. By 2030, it could exceed $3 trillion, driven by generative AI, smart devices, and AI-powered cloud services. Supporting this AI boom are massive data centers. By 2030, global data center investment is expected to reach $6.7 trillion. Many of us have heard about all the data centers going in. Just look in Northern Virginia. But behind those data centers is a massive need for electricity. For electricity, you need natural gas and other sources. And for natural gas, you need pipelines. I think you probably get the picture. AI will and is leading to investment in many different companies, whether directly or indirectly related to AI. The second chart we'll put up from JP Morgan shows electricity generation by source. I find this fascinating. Just check out data centers and EV forecasts. AI workloads alone will consume over 27% of total data center power. And it's not just big tech. Individual investors are joining this whole AI wave through venture platforms, AI-focused ETFs, and startup crowdfunding. This begs the question that some that were around during the tech bubble of 2001 may ask, what is the difference in then and now? Well, the current AI boom differs from the 2001 tech bubble in several key ways. While both are marked by intense hype and rapid investment, today's AI technologies are far more mature and already delivering real-world value across industries. Unlike the dot-com era, where many companies had no revenue and were built on purely speculation, AI leaders like OpenAI, Microsoft, and NVIDIA are generating billions in revenue, even if not yet profitable. The infrastructure supporting AI, including cloud platforms and advanced chips, is robust and scalable, unlike the limited internet backbone of 2001. Investments today are more strategic and globally distributed, with real products, enterprise adoption, and long-term partnerships driving growth. However, like the tech bubble, there are risks of over-evaluation and market saturation, making careful financial planning and due diligence essential. So there you have it, a summary on where AI is and where it's forecast ahead. There are many other things we could get into here, like autonomous driving, robots, etc. For now, we'll just stop here. Remember though, like any investment, we believe it is beneficial to remain diversified and long-term focused. We always enjoy discussing investments, and investments are important, but we believe having a financial plan is more important. After all, people don't plan to fail, they often fail to plan. Our team stands ready to help you, your family, friends, and coworkers plan accordingly for all types of life events. Now tomorrow, October 1st, we will celebrate 1 year of being the Legacy Advisor Group. Many of us have worked together for years before this new name change, but it is you, our clients, that we have to thank for trusting us and making us a part of your lives. I want to give a sincere thank you to you all, and we look forward to serving you and your families for many, many more years. As always, if you have any questions or concerns, please reach out to us. On behalf of our entire team here at the Legacy Advisor Group, thank you for your trust and your friendship.